In this video, traders, let's talk about stop loss insurance. Stay tuned. Hey guys, well, welcome to you. So what is stop loss insurance and do I think you should use it? Now, first of all, as always, this is just my opinion on things, absolutely not a recommendation. You big boys and girls out there, I hope and think you understand the risks associated with trading, and this is not advice, just my thoughts on stuff. So what is stop loss insurance? So some brokers, generally spread betting CFD type brokers, where they are the counterparties to your trade, as opposed to direct access brokers where you're trading directly on the futures exchange or you're trading directly on the stock exchange, will offer you what's called a guaranteed stop or stop loss insurance. So effectively what this does is it says, hey, we will guarantee you will be stopped at this price. Why would you want that? So the reason you might want insurance is this. Imagine if you have this scenario here and there's 2 days worth of trade. You're kind of long on this market here and the market then is closed. Okay, whether that's a weekend for Forex, whether that's overnight, a weekday if you're trading a stock. At that point in time, when the underlying is closed, you have no control over the risk and the price you come out. So let's say it closed at $10 here, just using some arbitrary numbers. And then the next opening session, it opens up down here and happens to be $8. Now, let's assume you don't know that yet. You're long from here and up to $10. You know what? Or let's say not long, because you have to do it actually at the time. Let's imagine you come to the close point here and you go, hey, I think this is going to continue for a day two type continuation play. I'm going to buy at $10. But then you start to think, okay, I've got this weekend risk. If it opens up on Monday lower, my stop's not going to get triggered, right? Because you know how stops work, guys. I've done a video on it before, and I'm sure you're aware. If you have a stop, let's say you had a stop at $9 here, for example, if it opens the next day at 8, you're going to get filled at 8. If it opens at 765, you're going to get filled there, because it's just that's the next available price. And what gets triggered, that's how stops work. So some brokers say, hey, you know what? Will allow you to use a guaranteed stop. And the guaranteed stop basically has a couple of parameters. So each are different, but they basically say this. They say, okay, for an additional spread, in other words, cost to trade, we will guarantee that in the stop loss that you attach to that, we will guarantee it will be filled. There are normally some caveats in terms of the distance of the stop. So you can't just have a really, really tight stop on it and guarantee it, because that would kind of be, you can game the system, right? Because you go long at $10 overnight, have a stop at $9.99, and you've got unlimited upside and 1 cent downside. And you could kind of play really, you could just game the system, right? You could just have a massive edge. Because if it gapped down by 10 cents, you're going to be out at just 1 cent loss. So there's normally the minimum distance, and that's kind of normally in percentage terms. So it might be, 20%, 10% on the share. I don't exactly know what it is, but there's normally a minimum distance, so you can't do that. But what it does is it just stops you from a catastrophic loss. And they say, hey, listen, if the next day opens well through your stop, we guarantee we'll fill you at this. Now, what's going on here? What's really going on here? They're basically selling you an insurance product. They're basically saying to you, okay, listen, we will take that risk on, but you have to pay us for taking on that risk. And so normally, let's say you've got a stock that's trading at $9.98 to $10.01, for example. That's quite widespread, but imagine that's the spread, okay? And that was normally how you trade. And if you went long, you were spread betting or CFD platform, you'd be long at 10.01. Now, if you're using a guaranteed stop, the quote generally, this is generalizing, will change to something like this: $9.95 to $10.05, for example, just for argument's sake, okay? Kind of reads a bit odd numbers there, haven't I? But you get the point. The idea is it widens the spread, so your cost to trade suddenly goes up by 4 cents. If you're going to go short, it goes up 4, 5, 3 cents, but it's 4 cents on this side if you're going long. So you're paying a little bit more to trade, and you might think, well, am I really paying more? Yes, because that's wrapped into the spread, and it's costing you way more. Your break-even point is now higher. If you went in at 10.01 and came out at 10.01, you'd be flat. Went in at 10.05, came out at 10.01, you would lose. And of course, the counterpart to your trade is the broker, so they would get the money. So this is how they do it. They say, hey, widen the spread for you. You can attach a stop to it, plus use guaranteed stop. And the increased spread means that that's the kind of insurance policy premium you're paying to guarantee that stop. And you might want to do that. You might say, okay, listen, I want to make sure that I am out at $9. Maybe there's something big coming out the weekend. I don't get caught out. Now, when might you want to use it? When do I think it's a slight waste of money? Now, again, not a recommendation, just my opinions on stuff. You have to do your own research and all the other good stuff. Don't want you going out there going, oh, I listened to this guy on YouTube and I've lost money. And come on, you know the game, So I think if you are in a very specific binary event, and let's say, this was a court case happening, for example, in this company over the weekend, and you thought, hey, you know what? If this works for them, this could rally by 20-30%. If it doesn't work for them, it could drop by 20-30, maybe more percent. Okay, so I'll trade it, but I want to cap my loss at really 10%. And if that guaranteed stop, the minimum amount is that 10%, you could say, okay, actually, I'm going to guaranteed stop in at $9. It's a maximum of 10% loss. I feel there's a binary event coming up. I can use that insurance. I don't mind paying a little bit more because I feel that the results of this are coming up. It's going to be a binary outcome. It's going to be up at $12 or $15, or it's going to be down at maybe $8. And if you can find that maximum level of stop for the company allows, and it's within the parameters and makes the trade look good, then that's not a bad deal, right? If you think, hey, there's a 25% upside, 25% downside, you believe it's a binary outcome of where it's going to go, and if you can get a stop between that 25%, say 10%, 15% even, then that's not a bad risk-reward ratio trade, is it? You're basically leverage on that insurance policy and you are using it for the right reasons. And if you find that scenario, they're rare, but if you find that scenario, you might want to use the guaranteed stop facility. Now, what about if you're trading normal market, let's say like a currency pair or DAX or Dow or any of these type of things? My instinct is that using those under those circumstances is not worth it. Over time, now you can use an individual, you can give an individual example and say, oh, look at this market gap down 1,000 points and you'd have been caught out if you were long. Yes, they are there to save you under those circumstances, but just think for a second what you're actually protecting yourself against. The minimum stop range is going to be massive. It's going to be multiple 100 points in the market you're trading, 100 pips. So this is an unlikely event. Okay, it's protecting you against an unlikely event. And there's still going to be a pretty big loss, because if you need that protection, you're probably going to be sized up quite big anyway. And so you're kind of like, well, what am I actually gaining here? Yes, I might cap my loss at 300 points instead of 500, or maybe 1,000 points, for example, but what am I actually really gaining? How often does that happen? If I'm constantly trading this, paying for this premium, is it really going to be effective? Is it really a valuable use of my money? Probably not, because if you think about it, as long as you're in the right trades at the right time, you've got a 50-50 chance of being 1,000 points for you, 1,000 points against you. Obviously, assuming you're not just trading on a binary event and hoping, let's assume some shock news comes out, it could be 50-50 other way. Shock news, bad news, shock news, good news. And if you're on the wrong side of it, it's a 50-50 shot. So there's that. And then the chance of it being a thick market moving that much. What sort of news will move the market that much? That's a pretty unlikely event to happen. And most of the time it's going to move and then trade. The gap may well not be that big. It's often the trade afterwards that pushes and pushes and pushes lower. Maybe it gaps down 300-400 points, but then it goes lower, maybe finishes down 1,000, but then you're well out. So you've got to kind of look and say, what's the minimum distance required for this guaranteed stop? And what are the chances of it doing that? And how many times have we actually done that? And if you're thinking like a trader, you probably should be thinking, or this is the way I look at it again, not guaranteeing anything, all this type of stuff, but you probably look at it and go, I'm paying for nothing here, really. I'm paying for insurance that actually is probably not going to ever pay out. I'm probably never going to be caught on something that is that devastating that is worth me paying continual insurance for. Because once you get into the habit of this, you can't just stop paying it. Like, okay, my model is to pay this insurance. I use the guarantee stop every time I hold over the weekend. That would have to be your view on it. Unless you, I suppose, decide under certain conditions to do that. And that's maybe there's a hybrid thing out there where you go, actually, under these conditions, maybe I will. But don't forget, these brokers are not stupid. When COVID was out and we had these big, massive gaps and stuff, and maybe when there's some significant news like an election result at the weekend, a German election result, you're trading the DAX, they're not going to have the minimum stop distance close. They're going to have it really wide. And they're basically going to say, and all it protects you, think about the wider it is, it's only protecting you for that extra little bit. If you imagine, the width of this gap, the wider they go with this and say, oh, you'll guarantee it up to, above 500 points only, it gets 300 points, you're still going to get slammed. You're still going to get hurt on the trade. So they're only protecting you against a very, very unlikely thing of 500 points plus, or 600 points, 700, whatever, 800 points plus. So you're not really getting that much insurance for those bigger markets, I feel. I don't feel like those bigger markets are worth it if you're doing that consistently. I think if you find a specific market where there's an anomaly of, hey, the minimum is quite generous, the broker says I can go quite tight on the minimum, and I think we've got a good chance, a reasonable chance, not just a, oh, I'm scared chance, a reasonable chance of gapping outside of that minimum one way or the other, position for one direction, hoping for one gap, have that worst case scenario capped off, you create an asymmetrical risk reward ratio trade, potentially. So anyway, those are my views on it, guys. Stop loss insurance, I think under most circumstances, for most traders, probably not needed. Again, my opinion only on it. I'm interested to know what you think in the comment section below. Do you use it regularly, and why do you justify using that? Maybe I'm missing something, it's quite possible. But if you get these kind of unusual circumstances, maybe it's a tool to consider. Take care, keep your risk managed, but maybe not with a guaranteed stop. Bye-bye.